Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. Yesterday, the Reserve Bank Board increased the official cash rate by another 50 basis points. The move was widely expected, the latest in a run of hikes as the central bank grapples with soaring inflation. But Reserve Bank Governor Philip Lowe also warned of higher inflation, weaker economic growth and rising unemployment to come. Gareth Aird is Commonwealth Bank's Head of Australian Economics. Gareth, welcome back to Fear and Greed.
G'day, Sean. It's good to chat with you again.
Any surprises for you yesterday afternoon?
Not really. Certainly not in the decision to increase the cash rate by 50 basis points. That was very much expected across the sell side of economists, and that was in line with our pick. So no surprises there. The RBA have upwardly revised their peak in the inflation rate to 7.75%. They had just a little while ago been talking about a peak of 7%. So that was somewhat surprising, albeit it did actually marry up with what the government said last week, when they said they now expect the inflation rate to peak at 7.75%. But overall, what we took out of the statement was that it does sound like the RBA is getting closer to the point at which they'll pause. I think there was a pragmatism in the statement overall. The governor has to go through literally what he said. He said that the board is placing a high priority on getting inflation back to the target range over time, but they want to keep the economy on an even keel, and the path to achieve this is a narrow one, he said, and clouded in uncertainty. So I think what that means is they're getting to the point at which they'll probably pause. We think that's an interest rate of around 2.6%. And I think provided they pause there, we won't actually see anything more in the way of rate hikes next year.
Okay, so just before we get to that, the Reserve Bank's not known for euphemistic language. And yesterday, the term, like even keel, isn't a term that I would imagine the Reserve Bank would use much, and the analogies of the narrow path and all that sort of stuff. It just sounded different yesterday.
It did a little bit. He'd actually made reference to that sort of language in a speech before, but I guess in Reserve Bank speeches, you get language which is a little bit more colourful. I think it did paint some good imagery, though. I think it leaves us feeling relatively comfortable with the idea that while the RBA is pushing through with what is a very aggressive tightening cycle at the moment, they just won't keep hiking rates willy-nilly, and at some stage they will actually pause. I think that's in the not too distant future, and provided they do that, they're not actually trying to take their policy rate to a contractionary setting and actually engineer what would be a hard landing in the economy, which is the path that some other central banks seem to be going down just because they're so focused on getting inflation down.
Okay, so how high do you think interest rates will go?
Well, we think they'll get to around 2.6%. We're still on these odd metrics, given the starting point was a cash rate of 10 basis points, and the Reserve Bank has just moved in, they moved in one 25 basis point increment and then 3 50 basis point hikes. So they've delivered actually 175 basis points of tightening over 4 meetings, which is effectively just over 3 months, which is an incredible pace of tightening. We think they've got another 75 basis points to go, which would get the cash rate to 2.6%. And they could either do that by another 50 and then a 25 or 3 consecutive 25s, something like that. That gets the cash rate around about to where the Reserve Bank thinks is the neutral cash rate, albeit they don't have a lot of conviction in that view, but they have sort of flagged it being around the midpoint of the target. Now, our work indicates that a cash rate at that level is actually a contractionary setting. And we think the neutral cash rate in Australia is about 100 basis points lower than that. So we think if they take the policy rate up to those kind of levels, the economy will slow quite significantly as we go through next year. And we've actually got a few cuts in our profile for the second half of next year.
Okay, so we might be at neutral now then, if that's the case.
Well, we think so. That's right. It's one of those things where there are a number of different ways to estimate, and depending on which way you do it, you get different numbers. But we look at it very pragmatically through what does an increase in the cash rate do to mortgage repayments as a share of household disposable income. And if all mortgage debt was floating in Australia, then at a cash rate of around 1.5%, you take mortgage repayments back to an average level, or share rather, of household disposable income. At a cash rate of 2.5%, mortgage repayments basically go to a record high as a share of household income because the stock of debt is so large. And it's very easy to sort of forget that we've been in a structural kind of decline in interest rates for about 30 years. And over that period of time, household debt has risen as a share of income. So that puts a lot of downward pressure on that neutral rate. And our work indicates it's around about 1.5%.
Stay with me, Gareth. We'll be back in a minute. I'm speaking to Gareth Aird, Head of Australian Economics at the Commonwealth Bank. I just want to quickly ask about the Reserve Bank itself. So 5 or 6 months ago, they were still saying 2024 for the first rate hike. Now, we've spent many months talking about this, but they're going so aggressively now. Is it about them catching up with the curve or with reality?
I think they've just been so surprised to the extent of which inflation has picked up. And I think they're also looking at what's happened offshore, where inflation has surprised to the upside on every central bank's forecasts. We've got an inflation rate here that's obviously very high, 6.1% through the year on the headline rate, but it's still quite a bit lower than many other central banks. And we do actually have a higher inflation target. I think that's sort of widely forgotten that the Reserve Bank has more flexibility given the inflation target here is 2 to 3%. But I think the reason they're going so aggressively is that the inflation data has just come in so much hotter than they expected. The unemployment rate is obviously very low as well. And they seem, up until this point anyway, just that they're in a race to get to their estimate of neutral. I think they don't need to be going at the pace that they're going, and think that going in clips of 25 would make a lot more sense, given there's a lot of forward-looking indicators of the economy that have slowed quite significantly in a very short amount of time. We found out yesterday that house prices now are falling at a pretty decent rate. New lending for homes was down quite significantly in June. Consumer sentiment is at recessionary type levels. So there's already a lot in the forward-looking data that suggests they don't need to be raising rates at the rate at which they're doing it. Having said all that, I think that they've just seen inflation data that's just so much higher than they expected and thought we need to get to our estimate of neutral as quickly as possible.
It used to be that it took about 12 to 18 months for the full effect of an interest rate increase or decrease to flow through to the economy. Just seems to be a lot quicker now.
It's a lot quicker in the way it is impacting certain parts of the economy. I still think you'll have quite a lag between changes in the cash rate and the impact that has on inflation. And that's why we need to be cognizant of the fact that the 175 basis points of tightening the RBA has so far delivered has had no impact on inflation. So we had 2 very strong quarters in Q1 and Q2 of inflation data, but none of that was actually picking up RBA policy tightening. And the inflation data for the September quarter probably won't either. But in terms of other things, though, you're seeing almost immediate impact in terms of what the RBA is doing and how the data's printing, and consumer confidence is a real case in point. Historically, households have felt relatively good about the economic outlook going into a tightening cycle, and they've stayed pretty optimistic, at least through the first few rate hikes, whereas this time around, as soon as the RBA started raising rates, consumer confidence has dropped like a stone. And I think that's picking up the fact that households just did not expect rate rises because the RBA was basically saying they didn't think they'd be raising rates until 2024. And not only that, the rate hikes have just come through so quickly and so aggressively. And there's lots of households out there that have borrowed a lot of money, and they're going to feel the pinch very, very quickly.
Okay, so bringing all this together, if the Reserve Bank does pick up the cash rate to about 2.6% or thereabouts, can Australia avoid a recession?
We can avoid a recession because the RBA has the ability to course correct. We're not talking here about an external shock causing a slowdown in the economy. We're basically talking about policymakers engineering a slowdown in the economy. And if it turns out to be the case that if the cash rate is around about that 2.6% level and the economy is slowing pretty significantly, and it's slowing in a way that means consumer spending is going out backwards, and therefore we're talking about the potential for a recession, well, the Reserve Bank can quickly course correct and cut the cash rate. So I think at the moment, if you were to forecast a recession for the Australian economy, you'd effectively have to say the RBA is going to take the cash rate to a contractionary setting, wherever you estimate that to be, and then leave it there as the economy starts going backwards. And I think the Reserve Bank would respond to data that indicated that was actually happening, and therefore we could avoid a recession.
Gareth, you've been an economist and now head of Australian economics at Commonwealth Bank, so you've got a very big job. You've been an economist for many years. It must be great to be an economist now, as opposed to 4 years ago, 3 years ago.
Look, it is to the extent that the job is incredibly exciting, and we're in demand. Clients want to speak to us probably more than at any other point in time. And in a lot of ways, when I think back to the years pre-pandemic, I'm not sure how we managed to fill an hour meeting with clients because you look at a lot of the data and nothing really was happening much month to month. Whereas right now we're at a point where we're seeing these huge changes and swings in the data. And we got that over the pandemic, but that was largely because the economy was being turned on and off due to restrictions being put in. But right now, the economy has clear air from lockdowns and restrictions, and yet we're still seeing incredible swings in the data. We've got a lot of volatility in financial markets, and we're going through a new cycle, basically a cycle where inflation is up, the Reserve Bank is tightening, and it's all happening at an incredible pace. So it certainly makes the job very interesting, and I don't think things are going to settle down for a little while either.
Gareth, thank you for talking to Fear and Greed.
A pleasure.
That was Gareth Aird, Head of Australian Economics at the Commonwealth Bank. This is a Fear and Greed daily interview. Remember, you should get professional advice before making any investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.